The countries that were supposed to be dependent on Western finance keep finding money somewhere else. That sounds strange because for most of the last 70 years, the script was simple. If a developing country needed billions for a railway, a port, a power grid, or emergency funding during a crisis, the conversation eventually led back to the same institutions: the IMF, the World Bank, the financial architecture built after World War II. And yet, over the past decade, something happened that many people outside policy circles barely noticed. China ended up financing more developing nations than the IMF and World Bank combined. Not through one dramatic announcement, not through a single treaty, just deal after deal, loan after loan, project after project, quietly. The reason this matters has very little to do with China itself. It matters because the global financial system has always been about leverage. Whoever finances infrastructure often gains influence over trade routes. Whoever provides emergency liquidity gains a voice in economic decisions. Whoever funds development gets invited into rooms where future decisions are made. Money travels first. Power tends to follow. According to research from institutions including Boston University's Global Development Policy Center, aid data, and multiple international development databases, Chinese state lenders issued hundreds of billions of dollars in overseas financing during the Belt and Road era. At certain points, China's overseas development financing exceeded lending from many traditional Western-backed institutions combined. That's the fact. The more interesting question is why so many governments said yes. Because critics often tell the story as if countries simply woke up one morning and decided to abandon Western institutions. That's not what happened. Many governments spent years trying to secure financing for projects that Western lenders considered too risky, too expensive, too political, or simply not profitable enough. A railway connecting inland Africa to a seaport, a hydropower facility in Southeast Asia, industrial infrastructure in Central Asia. Governments weren't necessarily choosing China over the West. Often they were choosing China over waiting another decade. There's an important distinction there. And if we're being fair, the Western argument deserves attention. Officials in Washington, London, and Brussels frequently point out that Chinese lending can create debt burdens. Some projects have struggled financially. Others generated less economic growth than promised. A handful became symbols of poor planning rather than successful development. Those criticisms aren't invented. Some are completely valid. But there's a gap in the conversation. If a country desperately needs electricity, transportation links, water systems, or industrial capacity, what exactly is the alternative? Wait? Hold another conference? Commission another feasibility study? Development doesn't happen inside PowerPoint presentations. At some point, someone has to pour concrete. One of the more quietly amusing features of international finance is that everyone loves infrastructure after it's built. Before construction begins, suddenly everyone becomes very concerned about risk assessments. The bridge somehow looks obvious only after it exists. What changed the equation wasn't merely China's willingness to lend, it was the scale. The China Development Bank and the Export-Import Bank of China became financial heavyweights almost overnight in historical terms. Together, they started deploying capital at levels that rivaled or surpassed many established international lenders. Remember those institutions? We're coming back to them later because they reveal something most discussions miss. This wasn't just Beijing writing checks. It was Beijing creating parallel financial machinery. And that's where the story becomes much larger than infrastructure. Because for decades, global finance operated on a largely uncontested assumption. When a nation needed development capital, there was a hierarchy. At the top sat institutions heavily influenced by the United States and its allies. Countries could complain about conditions, they could criticize the process, but they still had to participate. Then alternatives started appearing. First gradually, then all at once. The result wasn't a financial revolution. Revolutions are loud. This was something more subtle, a redistribution of options. That might sound like a minor difference. I don't think it is. When governments gain a second door to walk through, the first door suddenly loses some of its authority. And the numbers suggest that's exactly what happened. The The surprising part is that the biggest consequence may not be China's rise at all. It may be what happens when dozens of countries realize they no longer have only one place to ask for money, because history shows that monopolies behave very differently from competitors. And that's where this story takes an unexpected turn. Competition changes behavior. That's true in business, it's true in politics, and it's true in global finance. For most of the post-Cold War era, many developing countries operated within a system where the major sources of large-scale development funding came with relatively limited alternatives. The IMF had one role, the World Bank had another. Regional development banks filled specific gaps. Together, they formed an ecosystem that shaped how development was financed. The system wasn't created to be malicious. In many cases, it worked remarkably well. The World Bank helped fund infrastructure, education, and public health projects across multiple continents. IMF stabilization programs prevented outright economic collapse in countries facing currency crises. It would be dishonest to pretend otherwise, but effectiveness and frustration can coexist. Ask finance ministers across Africa, Asia, or Latin America about development funding, and a recurring complaint appears: time. Not ideology, time. Infrastructure delays carry costs that rarely appear in policy papers. Imagine a growing city where electricity demand rises every year. Every year a power plant isn't built means factories produce less, businesses expand more slowly, and households endure blackouts. Lost years compound. The same applies to roads, ports, railways, and transmission networks. Economic growth doesn't pause while paperwork moves through committees. China recognized something many analysts underestimated. The demand for infrastructure wasn't measured in billions. It was measured in trillions. The Asian Development Bank estimated developing Asia alone faced infrastructure needs exceeding $1.7 trillion annually through 2030. That's annual demand, not total demand, annual. Viewed from that angle, the question becomes less surprising. Why did countries borrow from China? Because someone was offering money at a scale that matched the size of the problem. Take Pakistan's energy sector during the early phases of the China-Pakistan Economic Corridor. The debate surrounding CPEC became highly politicized, but one fact is difficult to ignore. Pakistan entered the program facing severe electricity shortages that regularly disrupted industry and daily life. Multiple energy projects moved forward under Chinese financing arrangements. Were all of them perfect? No. Did debt concerns emerge later? Absolutely. But millions of people experienced a more immediate reality. Power generation increased. A government facing an urgent problem received infrastructure faster than it believed possible through traditional channels. That's the attraction. Not slogans, not geopolitics, concrete outcomes. A similar pattern appeared elsewhere. Kenya's standard gauge railway, Ethiopia's industrial infrastructure, ports in Southeast Asia, energy facilities across Central Asia. The specifics differed. The logic remained remarkably consistent. Governments looked at economic bottlenecks and saw financing attached to construction rather than years of negotiation. This is where many Western analyses accidentally weaken their own argument. They often focus heavily on the risks of Chinese lending while spending less time discussing the risks of underdevelopment. Both matter. A country can absolutely borrow too much, but a country can also fail to build the infrastructure required for growth. Those risks compete with each other, and policymakers have to choose between them in real time, not in hindsight. Here's where things get more interesting. Remember the China Development Bank and Export-Import Bank of China from Part 1? Most public discussions treat them like ordinary lenders. They're not. They're closer to strategic instruments. These institutions were designed to align financial power with national objectives. That distinction matters because it explains why China often financed projects that purely commercial lenders avoided. Profit mattered, strategic influence mattered too. Western governments understand this perfectly well. In fact, that's precisely why concerns started growing in Washington during the late 2000s and 10s. The concern wasn't simply that China was lending money. Countries lend money all the time. The concern was that financial relationships were creating long-term networks of economic dependence and political access. Ports connected to railways. Railways connected to industrial zones. Industrial zones connected to trade routes. Individual projects began forming systems. One agreement became 10. 10 became 50. Eventually, a map emerged. And that map stretched across Asia, Africa, the Middle East, Eastern Europe, and parts of Latin America. A dry way to describe this would be expanding economic integration. A more honest description might be that Beijing discovered infrastructure could accomplish things aircraft carriers can't. People don't trade through warships, they trade through ports. That doesn't mean China suddenly became the benevolent banker of the developing world. Far from it. Every major power pursues its interests. The United States does, Europe does, China does. The difference lies in the tools being used. And this brings us to the number that changed how many economists viewed the entire debate. Because while everyone was arguing about individual projects, researchers started discovering something much larger hidden beneath the surface. The actual scale of Chinese lending was significantly bigger than many governments had reported publicly. Some estimates suggested hundreds of billions of dollars in overseas obligations weren't fully visible in conventional international databases. Not necessarily secret, just fragmented across state-owned enterprises, joint ventures, development agreements, and financial structures that didn't fit traditional reporting systems. Suddenly, the conversation wasn't about whether China had become a major lender. That question had already been answered. The new question was whether a parallel financial architecture had quietly emerged while much of the world was looking somewhere else. And once you start examining that possibility, the story becomes considerably more complicated than China versus the West. Because the biggest vulnerability in China's model wasn't where most people were looking. And that vulnerability changes the entire picture. There's a detail that tends to disappear in debates about Chinese finance. China is not lending from a position of unlimited strength. And once you understand that, the entire story starts to look different. For years, the popular narrative had two camps. One side argued China was building an unstoppable financial empire. The other insisted Chinese lending was a debt trap destined to collapse under its own weight. Neither explanation fully survives contact with reality. The truth is more complicated and more interesting. Consider what happened after 2020. Many countries that had borrowed heavily entered periods of economic stress. Commodity prices swung violently. Global supply chains fractured. Interest rates rose. Currencies weakened. Governments that had looked financially stable a few years earlier suddenly struggled to meet obligations. This wasn't only a problem for borrowers, it became a problem for lenders too. A loan is an asset only if someone can repay it. China discovered that financing half the developing world creates a challenge most headlines ignored. Eventually, the bills come due. Aid data researchers, World Bank analysts, and multiple academic studies began documenting a growing wave of debt renegotiations involving Chinese lenders. Countries requested extensions, payment schedules were adjusted, terms were restructured. In other words, Beijing started facing the same reality every major creditor eventually encounters. Development finance is messy. Infrastructure takes years to generate returns. Politics changes, governments change, economic forecasts turn out wrong. Human beings remain stubbornly unwilling to follow spreadsheets. That last point has ruined more financial models than economists care to admit. Here's where the reversal arrives. Remember the assumption from the beginning of this video? The idea that China was replacing the Western-led financial system? The evidence suggests something stranger. China may have ended up becoming part of that system instead. Think about it. When countries experience debt distress, somebody has to coordinate solutions. The IMF gets involved. The World Bank gets involved. Regional lenders get involved. Private creditors get involved. And increasingly, Chinese creditors get involved too. Instead of destroying the existing architecture, China found itself sitting at the same negotiating table. That wasn't the original expectation, at least not for many observers. A decade ago, discussions often framed China's rise as a challenge to institutions created after World War II. Yet, when real crises emerged, parallel systems proved difficult to maintain. Financial networks naturally intersect. The world's economy is simply too connected. Sri Lanka became one of the clearest examples. Political decisions, domestic economic problems, external shocks, and debt obligations collided at the same time. The resulting crisis triggered intense arguments over responsibility. Some blamed Chinese loans. Others pointed out that obligations were spread across multiple creditors, including international bondholders and multilateral institutions. Both sides selectively highlighted facts supporting their case. The reality sat somewhere in the middle, which is usually where reality lives. What interested me wasn't the political argument. It was what happened afterward. Resolution required cooperation among creditors, who often viewed each other as competitors. China couldn't solve it alone. Western institutions couldn't solve it alone. Everyone ended up needing everyone else. That pattern has repeated elsewhere. Zambia, Ghana, Ethiopia. Different circumstances, similar lesson. Financial influence is easier to build than it is to manage. And that's where many discussions about Chinese lending become too simplistic. They treat loans as geopolitical trophies. They're not. They're long-term relationships, sometimes uncomfortable ones, sometimes profitable ones, often both at the same time. There's another number worth considering. According to various international estimates, infrastructure gaps across developing economies remain measured in trillions of dollars annually. Trillions. Even after all the Belt and Road projects, even after decades of World Bank lending, even after regional development programs, the demand remains larger than the available supply. That's important because it changes how we should interpret competition. Many people imagine a zero-sum contest. If China finances a railway, the West loses. If the World Bank funds a power grid, China loses. But infrastructure demand is so enormous that multiple lenders can operate simultaneously without exhausting opportunities. The bottleneck isn't a shortage of projects, it's a shortage of capital willing to take long-term risks. And that brings us back to the deeper question. What happens when dozens of countries suddenly have more than one source of financing? Because competition doesn't only change lenders, it changes borrowers. Governments gain bargaining power, conditions become negotiable, alternatives emerge, options expand. That sounds positive, mostly. Yet history contains a warning. When access to capital becomes easier, some governments borrow wisely, others borrow recklessly. The difference determines whether infrastructure becomes prosperity or merely debt with a ribbon tied around it. Which means the future of this story may depend less on Beijing, Washington, or Brussels than on decisions being made in capitals most people rarely think about. And that future is arriving faster than many analysts expected. Because the next phase isn't about who financed more nations, it's about who built the more durable system. Let's go back to the assumption we started with, the belief that global finance is controlled entirely by the West. Like many popular narratives, it contains enough truth to survive and enough missing context to mislead. The IMF remains enormously influential. The World Bank remains enormously influential. The US dollar still sits at the center of the global financial system. None of those facts disappeared because China financed railways, ports, or power plants. But another fact now sits beside them. The era when developing countries had only one meaningful source of large-scale development finance is ending. That's the real story. Not replacement, not domination, competition. And competition tends to produce strange outcomes. Remember the question from earlier? What happens when governments discover they have more than one door to walk through? We're already seeing the answer. Western institutions have started adapting. The European Union launched the Global Gateway Initiative. The United States and G7 partners introduced the Partnership for Global Infrastructure and Investment. Multilateral lenders have been under increasing pressure to accelerate project approvals, mobilize private capital, and respond more quickly to infrastructure demands. That pressure didn't emerge in a vacuum. When alternatives appear, incumbents move faster. They almost have to. A monopoly can afford patience. Competitors usually cannot. That's one reason I'm more optimistic about this shift than many commentators seem to be. Not because every Chinese-funded project succeeds. Plenty haven't. Not because every Western institution suddenly becomes more efficient. Many still move slowly. I'm optimistic because countries that need roads, ports, power grids, data infrastructure, and industrial capacity now have leverage they didn't possess 20 years ago. Leverage changes negotiations. Negotiations change outcomes. Outcomes shape development. That chain matters. Still, there's a risk here that deserves attention. More options don't automatically create better decisions. Sometimes they create bigger mistakes. Several governments borrowed aggressively during the easy money years, assuming growth would solve future repayment challenges. Growth didn't always arrive on schedule. Debt accumulated anyway. Infrastructure can transform an economy. It can also become an expensive monument to bad forecasting. The difference isn't determined by the lender. It's determined by whether the project generates real economic activity after the ribbon-cutting ceremony ends. That's the part politicians rarely advertise. A railway isn't valuable because it exists. It's valuable if people use it. A port isn't successful because it was built. It's successful if trade flows through it. The concrete is the easy part. The economics are harder. And this is where I think both sides of the debate often miss something important. Critics of Chinese lending sometimes act as though infrastructure itself is the problem. Supporters sometimes act as though infrastructure automatically guarantees prosperity. Neither position survives serious scrutiny. Projects succeed, projects fail. Countries make smart choices, countries make poor ones. Reality remains stubbornly resistant to slogans. What fascinates me is the broader trajectory. We're watching the gradual emergence of a more multipolar financial environment. Not fully multipolar yet, not even close. The dollar remains dominant. American capital markets remain unmatched in scale. Western institutions still possess immense influence. But influence is no longer operating without alternatives. And alternatives, even imperfect ones, change behavior across the system. That's why the title of this video matters. The myth isn't that the West has financial power. It clearly does. The myth is that financial power exists exclusively in Western hands. That stopped being true years ago. Many people simply haven't updated their mental map yet. My prediction? Over the next decade, the biggest development story won't be China replacing the IMF or the World Bank. I don't see evidence for that. Instead, I think we'll see a messy coexistence. Chinese lenders, Western institutions, regional development banks, sovereign wealth funds, private capital, all competing, cooperating, and occasionally frustrating each other while trying to finance a world that still needs trillions of dollars of infrastructure. That future will be untidy. It will produce successes and spectacular failures. It will also give developing nations something many of them have wanted for a very long time: choice. And when countries gain the ability to choose between multiple sources of capital, the balance of power starts shifting in ways that don't fit neatly into old assumptions. Maybe that's the lesson here. The story isn't that China became the world's banker. The story is that the world's financial landscape became crowded enough that no single banker can comfortably sit alone at the table anymore. If you enjoyed this analysis, subscribe and join me for the next one. There's a lot happening beneath the headlines, and sometimes the quiet shifts end up being the ones that matter most. After all, the easiest way to tell that competition has arrived is when everyone suddenly starts offering better deals.